CNBC-TV18.
The market's opened, Sonia, and it's absolutely flat for now.
We're currently down close to about 0.5%. The Nifty's up at 17,781.
The markets, they continue to be lower, but there has been substantial recovery from the lows as well. 50 points from the lows of the day.
From the word go today, there has been little but selling and red. Occasional bounces, as I think we've all come to get used to. The market will end, I think, 90 points lower. 17,765 is where the index will end at.
Hello and welcome to CNBC TV18. You're watching Markets Today, the show where we track about 6 hours of the day's trading action in 5 headlines. I'm Reema Tendulkar, and these are the headlines for the day. Indian indices close with cuts after a range-bound session. The sensex and the nifty lose little under 0.5% each. IT financials remain under pressure while weak earnings weigh on mid-caps. Coforge slips after 9.8% equity changes hand. Sources say promoter Bearings is the likely seller, while a quarterly loss and a sectoral hiring slowdown weighs on Info Edge. And in today's big earnings, Balkrishna Industries slides as weak demand hits sales. City Union Bank dives on poorer asset quality and margins. However, Oil India gets a boost from strong realization. Adani Group pledges additional shares worth more than 1,000 crore rupees to State Bank of India. All 10 group stocks close with cuts, even as State Bank of India clarifies that the group has not been granted any new loan. Additionally, Supreme Court calls for the regulator to look into big investor losses in Adani Group stocks. Metal stocks show their mettle after a week of weakness. Optimism over China's reopening helps stocks and prices recover, despite the dollar index remaining firm. And here's a lineup of what we have for you in store today. We bring you expert market opinion from Manishi Ray Chaudhary of BNP Paribas. We also have key commentary from Prime Minister Narendra Modi on India's defense sector. And the other big voice on the show today is SBI MD Swaminathan J on Adani Group companies pledging additional shares to the bank. And straight away, let's get to the day's trading action. A range-bound session saw Dalal Street end the day lower. The Nifty and the Sensex were down close to about 0.5%. IT financials remain the biggest drag for the markets. The mid-caps underperformed the benchmark indices. The mid-cap index was down 1.5% as weak earnings led to a steep fall in certain stocks. Prashant Nair is here with the details. Prashant.
We woke up to adverse global cues because you had oil prices which were higher, equities on Friday in the US which were down, and yields on dollar which was up as well. So it wasn't the most prettiest of pictures, and I mean the market started soft and almost immediately started selling off, from which there were occasional bounces through the course of the day, but there was no full recovery. And we ended 90 points lower. That's about 0.5% on the Nifty. Banks ending even with a sharper cut, 0.75% on the Bank Nifty in terms of losses that we saw. Losses on the Nifty, large cap index coming through in the Adani twins, enterprises and ports which were under pressure. State Bank of India lost. We had the management with us, of course. Infosys and TCS were the tech losers, and you had HDFC Life. Insurance companies and stocks had seen some bounces after the post-budget sell-off, but they're still sharply down. Gainers coming through on the index from Titan, L&T and NTPC, which ended the day up. Market breadth was negative, and it kind of flipped early on, never looked back, almost 2:1 in favor of declines. The broader pressure, lots of news-related names, earnings disappointments, and just profit-taking. Coforge, Naukri, Balkrishna Industries, City Union, Lupin, HBL Power, G Shipping, Kalyan Jewelers, Garden Reach, Sula, GICRE were just a few names. And these are the big volume-led losers that we had. There were gainers as well. So names like Oil India, which reacted to good earnings, Glenmark, Gland Pharma, Spark, Galaxy Surfactants, and Bector Foods were some of the gainers in the broader space. I think the global picture kind of becomes a little bit more important because of what's happening with two things mainly: the dollar, which is rising, and oil prices, which are also threatening to break above a range they've been in for some time. Out of the US, you get the consumer price inflation numbers. That is tomorrow night, and I think that is got the potential, not certainty, but the potential to turn the tide in favor of bulls once again, which got turned on the other side once the US jobs data came in very, very strong. Back to you.
Thank you very much for that. In market opinion, Manishi Chaudhary of BNP Paribas believes the valuation of new age tech companies will continue to be under pressure, adds that consumer staples aren't a good bet given the sector's high valuations.
We still don't have a representation from any of these companies. I think as long as we have cost of capital going up, through both risk perception rising and through the risk-free rates increasing, the pressure on the valuations of these new age companies would continue. These are the so-called long duration equity, the classic long duration equity, where a very large part of the value is in the terminal value. Even though many of these companies have declined significantly, I think as long as we have upward pressure on cost of capital, investors should be really selective in this space. Private sector banks, they clearly form the top of our asset allocation in the India silo of the Asian model portfolio. Apart from that, we have some exposure in consumer discretionary and in automobiles, even though we have reduced that exposure in automobiles a bit since early December. A couple of the sectors that we are avoiding right now, number one, consumer staples, where the valuations in the present circumstances and with the possibility of a dampened consumption sentiment, they don't really fit our bill. And we don't have any exposure in the metals and mining space either.
Okay, that's some market opinion. Let's get to the second headline now. Coforge slid close to about 7%. So early in the morning, there was a very large block deal of nearly 10% equity changing hands. 60 lakh shares changed hands at an average price of 4,050 rupees, and the total value of the block deal was close to about 2,500 crore rupees, 2,460. What we've learned from our sources is that the promoter of Coforge, that is Bearings, they are the likely seller in the block deal which took place today. Now, Bearings has been periodically paring down or bringing down their holding in Coforge. In September of 2020, their peak holding was close to 70%. Subsequently, in the last 2.5 years, they've been bringing down their stake, and with the latest tranche of 10% equity, which changed hands today, and if Bearings is the likely seller, then their stake comes down to just 30%. And that is a bit of an overhang on the company, and the question mark, right? What happens to the balance stake, of Bearings? Do they continue to bring it down, or does it stay at these levels? On the flip side, what we've also learned, which could emerge as a positive, as Nimesh has picked up from his dealing room chatter, is that now with the promoter holding coming down, many other investors will be present in it. So the free float in Coforge could go up, which could help increase its weightage in the key indices. So that's another, silver lining in the block deal which took place today. But the other one in the IT pack that we were tracking is InfoEdge, and that saw a very, very sharp cut. So let's quickly tell you what weighed on InfoEdge. First, the top line. The revenue growth for InfoEdge this time was 33.5%. Now, this is lower than the 50% revenue growth that it's seen in the last 4 quarters. Right? So revenue growth has slowed down. The key reason is IT hiring. Now, we've seen that IT hiring has slowed down. Attrition levels are not at the peak red hot levels that they were, as a result of which IT companies are not hiring so much, and IT was contributing about 50% to their overall Naukri revenues. Now, because that engine is not firing, the revenue growth has slowed down. Margins on the flip side, though, have continued to do well and improved. Margins are now at 39%. This is a multi-quarter high for InfoEdge's margins, and the key reason for that is ad spend has come down. But the other miss in the numbers is the bottom line. The company has reported a big loss of 84 crore this time. That's because they have written off. There is an impairment charge of more than 270 crore rupees. This is on account of an investment that they had done in a real estate platform called 4B Networks. Now, 4B Networks was struggling to raise some money given the winter that we are seeing for startups. That's the reason why InfoEdge has now written off its investments in 4B Networks. It's an impairment charge, and that impairment charge of 276 crore has turned the company into a loss-making company in the current quarter. So it's a combination of factors: the slower hiring in IT, the fear or the risk that more write-offs in investee companies could come to the fore in the subsequent quarters. That weighed on InfoEdge today. But that's about IT, Coforge and InfoEdge on our radar. Let's get to the third headline. It was a weak quarter for Balkrishna Industries, with weak demand hitting the auto ancillary company's sales. The stock shed more than 11%. Sonia is here with the details. Sonia.
As you rightly pointed out, the numbers were very weak this time around. And if you look at the EBITDA performance, EBITDA was down in double digits. A 17% fall is what we saw. The margins have fallen substantially, 19% versus almost 25%. Now, the management in their presentation said that there is inventory destocking that they've seen. Also, the situation across the globe is very challenging. Remember, Balkrishna Industries operates in the farm equipment segment globally in terms of agricultural tires, etc. They do off-highway tires as well. And that pocket globally has faced a lot of pressure, especially in markets like Europe, and hence their numbers have been under pressure. Now, in the conference call, they said that they expect the inventory destocking to continue in coming quarters. There is huge amount of finished stock currently lying at the dealer's end. The finished goods stock is currently at 2.5 months versus an average of around 40 to about 60 odd days. They expect the benefits of raw material inventory correction to flow in partially in Q4 and fully by Q1 of FY24. And they say that the benefits of lower input costs and freight will be at least 300 basis points. So that's a positive, but that will happen from Q1 of FY24. However, the problem really is in Europe, and over there the agricultural tire business has been under a lot of pressure. They are saying that given recessionary trends, they expect a low single-digit volume growth in the near term in Europe. They are still sitting on a debt of around 1,350 crores. So there's balance sheet pressure as well. And their guidance for FY24 in terms of capex stands at around 300 to 400 odd crores. So all in all, you'd have to say that large amount of inventory along with the recessionary trends in the global markets, especially in what's happening in Europe, is something that has spooked the stock. And that is the expectation that the company has in Q4 as well. So perhaps hence no recovery coming through even post the conference call. Back to you.
Thank you very much for that. City Union Bank was the other stock under pressure on the back of a weak set of Q3 numbers. The stock closed with cuts of 15%. Ekta is here with the details. Ekta.
Well, yes, it was definitely a disappointing quarter which came in for City Union Bank. Now, one of the key disappointments was on the asset quality. The slippages rose to 439 crores in the quarter versus around 261.5 crores. So it was up around 68% on a Q-on-Q basis, with the annualized slippage ratio coming in at around 4.08% for the quarter. One of the key reasons is because the bank did address the divergence observations of the Reserve Bank of India this quarter. The gross NPAs were worth around 186 crores were recognized in Q3 on account of this, but a part of it did get upgraded within the quarter as well. Now, the company is also guiding for a slippage ratio for FY23, which is now expected to be higher at around 2.5 to 2.8% versus the earlier guidance of around 2 to 2.5%. The FY24 slippage ratio is expected to be sub 2.5%. Net interest margins also came in at a 6-quarter low of around 3.88%. In terms of the basics, NII was up around 13.4%, but down 2.1% on a Q-on-Q basis, and the profits also slipped on a sequential basis. Provisions spiked up over 100% on a sequential basis. The key sore point was the asset quality.
Thank you for that. Get into a break, but stay tuned. We'll be back in a jiffy with the other headlines.
अरे भेज दिया डैड ने यार कहते जाओ